Hey, it's Dave Keller with Market Misbehavior. Today we're going to talk about Dow Theory, named after Charles Dow, considered the father of technical analysis. He wrote a series of essays in the early 20th century, which essentially turned into the discipline of modern technical analysis. One of his theories talks about the relationship between two major indexes, the Dow Industrials and the Dow Transports. Today we're going to see why they may not be as bullish as you think. Before we get to that chart, here's one more thing I want to tell you about. I'm a technical analyst, which means I spend hours every day looking at hundreds, if not thousands of charts. But in my own decision-making process, it's not purely technical. I actually spend a decent amount of time looking at fundamental factors that are actually driving companies and empowering them to grow for multiple years going forward. I look at macroeconomic data like the Fed and inflation and interest rates to think about how all those factors might impact those stocks and ETFs that I'm looking at. And I also have learned from spending years working with institutional investors that having a good quantitative model is super important. What a quantitative model does is basically look at the characteristics of successful stocks, looks at all the factors, technical, fundamental, everything, and wraps it into one rating, and then allows you to focus on the best opportunities within a particular set of stocks or ETFs. The good news is, as an individual investor in 2024, you have access to a pretty decent quantitative model through Seeking Alpha. If you go to marketmisbehavior.com/seekingalpha, you'll be able to take advantage of their quantitative rating. They actually have a pretty sophisticated quant model that is driving their quant rating. You can then cross-reference what we're talking about on this video, is looking at the charts of leading stocks, looking for big base breakouts and good technical opportunities, but also look to see if the quantitative model from Seeking Alpha supports the upside potential of those names. So go to marketmisbehavior.com/seekingalpha to find more information. Usually get a better deal for you. It's an affiliate link, which means that helps me make Market Misbehavior awesome, and we're all happy. So check it out, and let's get back to the charts here. So Charles Dow's original work used two indexes that he himself created, the Dow Industrials and the Dow Railroads. And the general idea here was you're looking at the two essentially pillars of the economy. The Dow Industrials representing the producers of goods, the Dow Railroads representing the distributors of goods. And the idea of what's called Dow Theory is when those indexes are in agreement, that tends to mean that economic conditions are fairly predictable or fairly straightforward. So when the Dow Industrials are making new highs and the Dow Railroads are making new highs, his idea was the producers and the distributors were all sort of in agreement. They're all doing well. Conditions are probably pretty good. When they're both breaking down, that's probably a bad thing, telling you economic conditions are relatively weak and you're getting consistent signals across different types of companies. When one would make new highs and the other would not, that was called a non-confirmation. It usually meant the market was ready for a major reversal. Looking at the chart here, we have the Dow Industrials in the top panel and the Dow Transports in the bottom panel. We're using the Dow Transports because it's essentially the Dow Railroads eventually evolved into the Transportation Index. Originally, Charles Dow only had 15 stocks in each of those, if I remember right, and now we're up to 30 stocks in both the Dow Industrials and the Dow Transports. So what's interesting about the traditional Dow theory, and again, the idea is we're looking for agreement. We're looking for when these indexes are doing the same thing. So if you look at September, October of 2023, you see both of those are making new swing lows. They're making lower highs and then new lows. And so when they're both making new lows, that's called a Dow Theory confirmation, or a bearish confirmation. When both of them are making new highs, for example, like you might see here, maybe July of 2023, you could argue that was a Dow Theory buy signal because both of them were breaking out. The really valuable signals, in my experience, is when you have what's called a non-confirmation, when one index is doing something and the other is not confirming it. So here we have the Dow Industrials making a new high from March into May. Now, this may look familiar because the S&P and the Nasdaq have very similar patterns. They've all made new highs in May. In Dow's case, actually making it above 40,000 for the first time in history. As you can see, we've pulled back a little bit in the week since reaching that 40,000 threshold, but the Dow Industrials did in fact make a new high. And again, the S&P and the Nasdaq did as well. Note how the Transportation Index actually made a lower high. So according to Charles Dow's original work, this is called a bearish non-confirmation, where the industrials are breaking out, but the distributors of goods, the Transportation Index, is actually sloping downwards. And so while the market appears bullish because one of those is making a new highs, it is not truly bullish because it's not confirmed by a broader representation of the economy. As you're listening to me talk about these two indexes, anything jump out at you as being maybe a little antiquated or a little ineffective at describing the current market environment in 2024? Here's the thing. We're looking at 30 industrial stocks. And back in the day when Charles Dow was creating this, think of things like GE and GM, like all the generals, right? Big industrial conglomerate type of companies making stuff. The transportation index were a bunch of railroads, which were literally the main way that goods were distributed across the United States. Now, of course, railroads are just one of the ways that that those can be distributed. Things like Amazon and others who actually have built-in distribution systems really are both a producer and a distributor, and those really aren't accounted in any way in these indexes because they may not be a member of the industrials, and they're certainly not a member of the transportation index, which includes a bunch of things like airlines and other things that have other parts of their business. So the problem with the Dow Industrials and the Dow Transports in 2024 is that it is less reflective, in my opinion, of what Charles Dow originally was trying to do, which was looking at agreement from different parts of the economy. Having said that, people still follow these signals, and as surprising as it might be, they have tended to be fairly effective. So the fact that we have a bearish non-confirmation is, in fact, a very bearish signal here as we get toward the later parts of May 2024. Now, Charles Dow's work, I think, can be adapted to more of a modern economy, right? Back there, it was a very product-oriented economy, and so you had big industrial producers producing things and then selling them. Now, of course, we're in more of a service economy, right? Back in 1960, you know what the biggest sector was in the S&P 500 was the materials sector. In 1980, I think it was energy, if I remember right. 2024, it's neither of those things, right? It's more things like technology and consumer and communication sectors. These are the largest sectors in our current market because, again, we're in more of a service-oriented economy. So I think one way to modernize Charles Dow's original work is to look at the S&P 500 and the Nasdaq Composite. Now, I'll tell you right off, this is not a perfect representation of the modern economy, but it's as best as I've found. You'll see in a minute I have a newer Dow theory which I would propose, but for now it's not too bad. The idea is the S&P 500 represents the old economy. The Nasdaq Composite represents the new economy. Now, before you put in a comment saying you don't know what you're talking about, fair enough. There's a lot of duplication here. So names like Microsoft and Alphabet and Amazon and others are counted in both of those because they're in the Nasdaq Composite. And there's certainly also some of the biggest weights in the S&P. And that is one of the challenges with this particular visualization, this particular modernization of the Dow theory. Now, with that in mind, though, note that the S&P 500, of course, has made a new high in May of 2024, a new all-time high. The Nasdaq Composite has as well. So both of these benchmarks have made new highs. Here's the problem, right? If you really have looked into the return profiles over the last 6 months, you know the mega cap names, those magnificent 7 or FANG stocks continue to dominate. The 10 largest stocks in the S&P are about the same weight as the smallest 425 members of the S&P. That's how big of a weight those mega caps have in these major benchmarks. So while this is bullish and has given a bullish confirmation, a confirmed bullish signal, I would say it's not a great representation just because of the mega cap bias in both of these indexes. That's why I think maybe what we could call a newer Dow theory combines an equal-weighted S&P 500 and an equal-weighted Nasdaq 100. Again, not perfect. I don't know if we could find a perfect idea here, but I would tell you that this is a better representation of the companies represented in the S&P 500 and not just looking at the 10 to 15 largest companies, which is what the benchmarks are primarily geared to do. When we look at an equal-weighted S&P 500, we can see it has actually not made a new all-time high in May. The late March high still is higher than what we reached just recently earlier this month. The equal-weighted Nasdaq 100 has also not made a new high. So think about that. The S&P 500 has made a new high. The equal-weighted S&P 500 has not made a new high. Now, well, that's not technically Dow theory. It does speak to concerning realities about the breadth conditions. One of the great, I think, buy or bullish signs in 2024 has been improving breadth, an expansion in new highs, lots of stocks above moving averages, bullish percent index quite high. We're actually starting to see some of that unwind here March, April into May, where a lot of stocks are actually failing to hold their 50-day moving average, and the equal-weighted S&P 500 not making a new high while the S&P does tells you that the breadth is not as strong as the major benchmarks may indicate. So that's where we're at in May 2024. We have the traditional Dow theory giving, in my opinion, a clear sell signal. This is a bearish non-confirmation indicating that the current market structure is not as bullish as the chart of the S&P may indicate. The new Dow theory, looking at the S&P and the Nasdaq composite, has actually confirmed by both breaking out. But I would say that is really dominated by the mega cap stocks. When you take that weight out of the picture by using equal weighted versions, the RSP and the QQQE, you can see neither of them are making new highs. So perhaps the markets are not as strong as you might expect, while the S&P and the Nasdaq are making new highs. What do you think going through May and into June of 2024? Do you think Q2 is going to finish stronger or weaker? Don't forget to drop a comment below and let me know. For Market Misbehavior, I'm Dave Keller. Have a great one. We'll talk to you again soon.